Well, what an incredible difference a week makes. Markets have calmed themselves and the volatility has subsided significantly since Friday. Underneath that, though, there have been some quite big moves this week that we need to be aware of. So the yields on 10-year government bonds have fallen quite considerably across the board in terms of globally, so the US, UK, Germany, Japan. We've seen the Bank of England signal a rate cut in the summer, so the market's starting to price in a 25 basis point rate cut in the summer, and perhaps further if we do go into recession later in the year. We've got the currency at a 31-year low against the dollar. We've got the 10-year gilt at a record low, 0.8%, and we've got the FTSE 250 down 6.1% since the Brexit vote. More positively, we haven't seen any contagion into Europe, so those peripheral debt spreads have not widened markedly, and actually the cost of debt in Spain, Italy and Portugal has actually come down, in part helped by the ECB and further buying this week. So, however, the headline number of the FTSE has been the number that's been grabbing the most attention, and that has been incredibly resilient. In fact, we're at 2.6% above where we were on Thursday night. So why is that? Well, there are three main reasons. The equity yield on the FTSE has now become more attractive relative to the bond yield because bond yields have gone down. And equity yields, the yield in a lot of FTSE 100 businesses is supported by overseas earnings, and they've got more valuable. In terms of overseas buyers, these UK assets have got 10% cheaper. So if you look at this chart, you can see the FTSE in terms of US dollar denominated and GBP denominated. So we're still 10% off where we were last Thursday for a US dollar buyer of the UK FTSE. So that gives you a sense of why it has been deemed to be attractive. For us, the equity yield ratio remains the really key factor, particularly if we're in a period where bond yields are continuing to fall and growth is low. Investors will be pushed into equities in search of that yield. And where they can find defensive yield, they will buy it. And as you can see from the movers this week, it's the foreign earners, it's the staples that have performed very well. And the worst performers have been obviously the domestically focused stocks where we've got more uncertainty about their earnings. So these charts show what's happened to the EPS estimates for these two groups of stocks over the week. Here we've got AstraZeneca and RBS, where we've seen RBS in red. The earnings estimates rise quite considerably over the week, as with AstraZeneca. But if you look at the domestic stocks, we've seen downgrades to their earnings expectations. Here's Taylor Wimpey, and also with Lloyd's. But what you've also seen is the spread in the possible outcomes that analysts see for those particular businesses, and therefore that increased uncertainty is the reason why we've seen quite considerable falls in the domestically focused stocks. Clearly, we now look at where those dividend yields are and the likelihood of those dividend yields being paid, and therefore assess whether we've got an opportunity to buy those stocks at far cheaper valuations than they were a week ago. Equally, in terms of the way the market is moving, we're seeing a very close correlation with the sterling dollar rate and the FTSE 100. Essentially, the FTSE is following that cable rate. And therefore, now that we've gone into a period where the Bank of England is signalling that rates will be cut, the market will become increasingly sensitive to UK economic data. So we'll be watching GDP figures coming through, which one will expect will be slightly worse as a result of this. But we're also watching inflation data, and this is really interesting that inflation data has actually picked up over the last few days, which is reflecting the fact that imported goods will cost more coming into the UK. On the other side of that currency play, we have to look at what's going on in the States and whether we feel that the States is getting stronger relatively or weaker relative to the UK, and that's not a one-way situation. So over the last couple of weeks, we've seen a real decrease or deterioration in the economic data coming out of the States, and the forward-looking data for the US is as bad as it has been for quite a long time. So we go into next week where we've got a US jobs number on Friday on the back of a poor one last month, and that's a very key piece of data. Equally, we've continued to see the RMB depreciate against the dollar, and that has continued through this week, and that is pushing inflation expectations down for the US. So to sum all of that up, we continue to feel that the yield argument for equities is very strong. Sterling weakness will help some areas of the UK economy, but we have to be aware of slowing global growth. We continue to feel that with bond yields coming down where they are, growth in a low growth environment is getting more and more valuable. So we go back to those big growth thematic stocks that we've been talking about a lot. Here you've got a chart that's interesting, just showing the probability of a US rate rise this year, which has clearly gone down, and the probability of UK cut this year, which has gone up. So you're seeing across the board the likelihood of longer for lower in terms of interest rates, which is beneficial for those growth businesses. Looking ahead, we have reached the end of the Q2, so Q2 reporting will pick up not next week but the following week. We're starting to see some more results coming in. We've got Imagination Technology on Tuesday, which should be a big beneficiary of the sterling devaluation. We've got Walgreens, we've got Marks & Spencer's, Pepsi and Samsung, which will all be of interest next week. So that's it from me. Thanks for listening.